You ever wonder what it really takes to run one of the world's, biggest companies? Not just what you see online or in the store, but the actual engine running it all.
Yeah, trying to get your head around something the size of Walmart, it's
Right.
immense. But they actually give us a pretty detailed look inside every year.
Right, that annual report they have to file,
hmm
the Form 10K.
Exactly. It's their official deep dive into the business. Strategy, financials, risks, and it's all of them there. Dense stuff, sure, but straight from the horse's mouth, basically.
Okay, so that's what we're digging into today.
Right.
We've pulled out key bits from Walmart's latest 10K, the one for the fiscal year ending January 31st, 2025.
Mm-hmm.
And our mission, really, is to unpack the most important pieces for you, how they structure the business, the financial story for the year, what they're doing for shareholders, and the big challenges they see coming.
It's like getting a guided tour, but through the official documents. We're not just reading numbers. We're trying to understand the why behind them, the strategy, what's driving things, what keeps them up at night.
Okay, let's dive in. First up, how do they even organize this massive thing? The report breaks it down.
Yeah, they talk about three main reportable segments.
That's right.
You've got Walmart US, that's the big one, the stores and website here. Then Walmart International, covering, well, everywhere else, 19 countries. And finally, Sam's Club US, their membership warehouse business.
Okay. And do they all contribute pretty evenly, or?
They all consistently contribute to sales, yeah. International can bounce around a tiny bit because of currency changes, but broadly speaking, they're all major parts.
And they spell out a core strategy, right? I think I saw a quote.
They do. It's to make every day easier for busy families, operate with discipline, sharpen our culture, and become more digital. That's their stated goal.
Makes sense. And underneath that,
It really comes back to their classic model, everyday low prices, EDLP. But crucially, they can only do that because they're obsessed with everyday low costs, EDLC. It's all about efficiency behind the scenes.
got it. And a huge theme, it seems, running through all those segments is blending the physical and digital omnichannel.
Absolutely. That's central. Look at Walmart US, huge footprint, right? Something like 4,600 stores, nearly 700 million square feet.
Wow.
But they're not just stores anymore. They're critical hubs for getting stuff to people.
You mean like for pickup, same-day delivery
Yeah,
type of thing?
exactly. Same day pickup, delivery, express delivery, even delivering into your home. Plus the digital pharmacy side. It's using that network for speed and convenience.
And that ties into things like their Walmart Plus membership.
Precisely. Bundling free shipping, delivery perks,
Hmm.
making that combined physical digital experience smoother. And they sell everything. Groceries are massive, general merchandise, health stuff.
Yeah.
Leaning hard on their own brands, like great value equate.
Okay. Then moving overseas, Walmart International. Still
No.
a huge scale.
Oh, yeah. Over 5,600 locations across those 19 countries, about 274 million square feet. Interestingly, they mention using a 1-month lag for reporting results from most places outside the US and Canada.
Huh. And the strategy there. Same omnichannel focus.
Pretty much the same playbook, extending pickup and delivery, building out their online marketplaces. They use a mix of global and, local private brands too. They mention names like Herrera and Later.
The report also mentioned some big moves they made internationally recently. Strategic changes.
That's right. They bought the rest of their MassMart subsidiary, upped their stake in PhonePe in India, and sold off their investment in JD.com.
Oh, yeah, the JD.com sale. That was significant, wasn't it?
Very. Pulled in about $3.6 billion in cash back in August 2024. That's a decent chunk of change.
Okay. And the third piece, Sam's Club US. How does that fit in? It's a bit different, right? Membership model.
Totally different model. Around 600 clubs, 80 million square feet. It's all about membership value, club tier, plus tier. They have their own distribution centers, but also, interestingly, share some facilities with Walmart US. Shows that operational synergy.
And they keep adding member perks.
Seems like it. Free curbside pickup for club members on bigger orders, plus members get free delivery early shopping hours. And they launched that Sam's Cash Rewards program a couple of years back. Their members' mark private brand is really key there. Like, great value is for Walmart.
So if you zoom out across all three segments, what's the connecting thread?
Investment. Definitely investment. Pouring money into automating the supply chain, getting goods moving smarter and faster, and investing heavily in the digital side, the apps, the website, that whole experience.
And it's not just tech for tech's sake.
No, they explicitly link it to making their employees, their associates, more productive too, better tools for them.
Okay, that paints a really clear picture of the structure and the strategy. How did all that add up financially last year? What did the numbers look like?
Well, just the scale is mind-boggling. Top-line revenue for fiscal 2025, about $1.05 trillion.
Wow, over $1 trillion. And how do they measure growth? They use comparable sales.
Yeah, that's sales from stores or clubs open at least a year, plus all their e-commerce sales. And they lay out their financial priorities pretty clearly, too.
Which are?
Growth, basically serving customers better, getting new ones, margin improving operating profit through efficiency and selling a better mix of products, and returns, getting a better return on investment.
Okay, let's talk profit. Net income. What was the final number?
Consolidated net income for fiscal 2025 hit $20.2 billion.
And how does that compare to the year before?
That's a pretty healthy jump. It was $16.3 billion in fiscal 2024, so an increase of $3.9 billion.
Okay, and per share.
Yeah.
Earnings per share, EPS.
That went up too, $2.41 per share in fiscal 2025, up from $1.91 the previous year.
That's a significant boost. What was driving that improvement?
Well, it's a few things. Operating income itself was up a bit in the U.S. segment, but looking at the whole company, operating expenses actually increased in fiscal 2025.
Right. Why was that?
Mainly higher variable pay, think performance bonuses, more spending on marketing, and higher depreciation costs, which kind of reflects those big investments they're making in tech and automation.
Right. So costs went up in some areas, but net income still jumped quite a bit. How does that work?
Well, part of it is looking back further. See, operating expenses actually decreased in fiscal 2024 compared to fiscal 2023. That earlier year, 2023, had some huge one-off charges.
Like what?
Specifically, that big $3.3 billion opioid settlement payment and about $0.8 billion related to separating Flipkart and PhonePe internationally. Those big hits weren't repeated in 2024.
Ah, okay. So fiscal 2024 looked better partly because those massive costs were gone, and then fiscal 2025 built on top of that, even with some spending increases. Makes sense. What about gross profit, the margin before those operating costs?
That improved too in fiscal 2025. The report points to better efficiency in how they manage inventory and move merchandise, plus better margins on fuel sales.
There's always a but.
Right. But those gains were somewhat offset by higher costs for fulfilling e-commerce orders, picking, packing, shipping, and also because customers shifted some spending towards products with lower profit margins.
So, like, selling more groceries online might bring in revenue, but the profit percentage on those sales could be lower.
Exactly. It's that product mix effect. And interestingly, in fiscal 2024, the gross margin improvement was mostly because they didn't have the big markdowns they needed the year before that. Mix shift was a factor then, too. It really shows how these operational details matter at their scale.
Okay, performance is one thing, but what about those return metrics they prioritize? Return on assets, return on investment.
Both went up. ROA, return on assets, was 7.9% in fiscal 2025, up from 6.6% the year before. They say that's mainly down to the higher net income we talked about, plus some positive changes in the value of their investments.
And ROI, return on investment.
Also ticked up from 15.0% in fiscal 2024 to 15.5% in fiscal 2025. That was driven by the better operating income, so core business performance improving. It was held back slightly, though, because their invested capital base grew.
Meaning they spent more on things like
Property, equipment, technology, the stuff needed for future growth.
Yeah.
They actually explain how they calculate ROI in the report, which is interesting. It shows that focus on disciplined investment.
So profit up, returns improving. How did that look in terms of actual cash coming in and out, cash flow?
Cash from operations was strong, $36.4 billion generated in fiscal 2025, which is slightly up from $35.7 billion the year before.
Okay, solid. But what about free cash flow? That's often seen as the key number, right? The cash left after investments.
Right. And free cash flow is actually down. It came in at $22.4 billion for fiscal 2025, compared to $24.4 billion in fiscal 2024.
Well,
Operating cash was up, but free cash was down. Why the difference? They spell it out pretty clearly. It's because capital expenditures, CapEx, basically they're spending on long-term assets like stores, tech, warehouses, increased by $3.2 billion.
so they generated a bit more cash, but they chose to reinvest a lot more back into the business.
Exactly. They state that increased spending directly supports their investment strategy. So less free cash left over this year because more was put back to work building for the future.
Makes sense strategically. And they have debt too, obviously.
Yep, long-term debt was about $36.0 billion at the end of January 2025. But they also highlight their very strong credit ratings, which basically means they can borrow money relatively easily and cheaply if they need to.
Okay, so financially solid, generating cash, investing heavily. How does this translate into value for shareholders, the people who own the stock?
Well, the two main ways mentioned are dividends and share repurchases, or buybacks.
Dividends first.
They state the current quarterly dividend is 0.235 cents per share, and they even list the payment dates for the rest of 2025 and early 2026.
Pretty steady return there. And the share buybacks. Sounds like they have a big program.
They do. A $20 billion program authorized back in late 2022, and it doesn't have an expiration date. As of the end of this past fiscal year, they still had $12 billion left on that authorization.
So plenty of room to keep buying back shares if they want to. Have they been active?
Oh, yeah. In fiscal 2025, they spent about $4.5 billion buying back almost 62 million shares. Average price around $72, $73.
In the year before?
Fiscal 2024, they spent less, about $2.8 billion, buying back around 55 million shares at a lower average price, nearer $51. They expect to fund these mostly from that free cash flow.
So cash coming back to shareholders directly via dividends and indirectly by reducing the share count through buybacks. But as we know, running a global giant like this, it's not all smooth sailing. The report talks about risks, right?
Oh, absolutely. A big section is dedicated to risk factors. They make it clear success isn't guaranteed. One major challenge is just how competitive retail is, especially with this omni-channel shift. New players, well-funded ones, are always popping up.
And if Walmart doesn't adapt fast enough?
They say failure to execute their omni-channel strategy or respond to competitors could really hurt performance. And competition isn't just price anymore, right? It's selection, service, convenience, the tech platform, delivery speed, everything.
Makes sense. What else worries them? The economy.
Definitely. Big economic factors, changes in consumer income, debt levels, inflation, currency swings impacting their international results, tax law changes, trade issues like tariffs raising costs, all potential headwinds.
And their supply chain must be incredibly complex.
Vulnerable.
For sure. Things like geopolitical events, pandemics, labor shortages, rising transport or fuel costs, infrastructure problems, even extreme weather. Any of those could disrupt the flow of goods. Supplier stability is another one they mentioned.
And in our world, cybersecurity has to be high on the list. Huge risk. They talk about increasingly sophisticated threats, malware, ransomware, trying to breach their systems to get customer data, payment info. And then there's the whole web of data privacy laws, GDPR, CCPA, others globally. Staying compliant is complex and expensive, and the fines for slipping up can be massive.
Wow, yeah. That's a minefield just on the data side. The report also mentions specific legal issues they're dealing with.
Yes, several significant ones. The opioid litigation is still ongoing, even after that big settlement payment a couple of years ago. There's an EPA matter about refrigerant leaks, an antitrust probe in India involving Flipkart, and lingering obligations from the Asda sale in the UK related to equal pay claims.
They also bring up ESG, environmental, social.
Yeah, basically acknowledging that stakeholders, investors, customers, employees care more and more about these things, and managing them is important for reputation and risk.
And people are key too, right? Human capital.
Absolutely critical. They employ 2.1 million people globally, about 1.6 million here in the U.S., mostly hourly workers.
Yeah.
They talk about investing in them, wages, benefits, career growth, well-being programs, but balancing that with controlling costs and just finding and keeping good people is a constant challenge.
So if you wrap it all up, what's the overall message from the 10K about the road ahead?
I think it reinforces their core focus.
Yeah.
Drive that omni-channel growth, squeeze out better margins, deliver good returns, and they're backing that with serious money in tech and supply chain. But, and it's a big but, they are very aware they're doing this in a really complex world, juggling competition, economic swings, operational risks, cyber threats, legal issues, regulations. It's a massive balancing act.
Wow. Yeah, we covered a ton there. We looked at how they break down the empire, the financial results, including that big jump in profit, how they return cash to owners, and crucially, all those significant risks they're managing, all straight from their own report.
Hopefully it gives you a clearer sense of just what goes into running a business on this scale. It's way more than just stores and websites. It's this incredibly complex machine trying to navigate all these global forces.
It really makes you think. Given that sheer size, the pace of change in tech, the global complexities, how does a company like Walmart keep that core promise of everyday low prices while needing to pour billions into constant investment and adaptation?
That's probably the fundamental tension, isn't it? Balancing that low-cost promise with the need to constantly evolve and invest. It's a tightrope walk this report really highlights.
Well, thanks for joining us on this deep dive. Hopefully it gives you some interesting things to chew on.